Geoff Lacher. I'm a senior economist with Tourism Economics. I've been working with uh, the Myrtle Beach DMO for about 3 years now, providing a decent bit of analysis, and I guess I'm excited to be here today. What we're going to talk about, and can you confirm we're up on the screen share?
Yep, everything looks great.
Right, and yeah, let me apologize first off. My children are trying to kill me. I'm recovering from both a cold and pink eye, so great times here. If I do mute and shut off my camera really briefly, it's because I'm sneezing, and I'll be right back with you, so don't worry about that. What we're going to talk about today is really 4 items. We're going to do a quick overview of the lodging forecast we provided earlier, I guess in November. Then look at the macroeconomic environment. Is there a recession coming? What impact does recessions typically have on the travel sector, and why we think even in the face of some difficult economic times, we think the travel sector is going to prove resilient through the upcoming troubled waters. To get right into it, we did this forecast, which we're going to take a look at in a second. We're going to take a big look at the upcoming macroeconomic environment, what we think is happening there, but some other kind of key particular highlights. The forecast does assume that COVID-19 kind of keeps receding and has less and less an impact on travel behavior and the economy. We do see international improving, we see business travel improving faster, leisure travel, especially places like beach, is already back really strong. Continue to see that happening. As you know, same deal with food travel. There's the risk there and the aversion continuing to get less and less over time. And we'll do a full review of the macroeconomic environment a little later. Here's kind of the big deal. We provide this on a monthly basis out through 2023. I'm going to ask you to focus on that red box, which is an index where we kind of start everything at 100 and either shrink or grow it at the rate of increase from there. Basically, you're doing really amazingly well. And we have seen this in a lot of places through COVID, that there are certain types of destinations that have been really successful, and you profile like that as a more rural beach destination where people can come spread out and practice social distancing. You've really knocked it out of the park here, and things are going incredibly well. Demand 2020 is about 20% up from before the pandemic. RevPAR about 43% up compared to before the pandemic, and accommodation revenue about 50% up compared to before the pandemic. You did have, especially compared to the nation, an amazingly strong 2021. Those growth rates did tail off a bit in 2022, and we see that tailing off continuing going forward in 2023. But overall, just amazing numbers, and we do see these continuing to increase, even if it is going to be at a slower pace. You see, those big numbers in 2022, not just reflected in your lodging sector KPIs, but our estimated visitor spending for you, all the various taxes and fees that are collected specific to the tourism hospitality sector. Just everything going really well, and we see that continuing in the future, again, albeit at a slower pace. Again, not going to go over the quarterly results, just let you know they're out there if you do have particular questions on what's going on in a more granular type of way, but again, a bit too much for the presentation. How this looks graphically, we track accommodation revenue in millions of dollars on the left, and then percent change. We do think it's important in this higher inflation environment to look at both nominal, which is not inflation adjusted, and real, which does adjust for inflation. And so you do see the disparity there. Looking at 2022, again, you're about 52% up in nominal dollars. That's only 36% up in real dollars. So still outstanding, but does take a tiny bit of the shine off those outstanding numbers. You see those. While we see in 2023 nominally growing, we think inflation is going to take a bite, and the real lodging spending is actually going to shrink just a tiny touch. Again, we have this monthly. Here's how we have it tracking. Um, we do see a bit of a lull in the upcoming summer months. Again, partly due to some slower economic times, but again, looking good and increasing into the future. So moving over away from Myrtle Beach in particular and looking at the general economy before we get into how it's going to impact the tourist section. So we'll start with happy news and slowly get a little sadder. You should mention the unemployment rate is still at just historically low numbers, just a smidge off all-time previous lows in unemployment rate, but overall doing outstanding there. Really quick recovery of jobs. Speaking of jobs, this is kind of the rate of that we're increasing jobs in a normal environment. Anything over 200,000 jobs added a month for the nation is considered a really good number, and we're still well above that 200,000. At the same time, you do see the total jobs added tapering off as we hit this this low unemployment number. So this does reflect a cooling economy, even if these numbers are still really strong. After a couple rough quarters there in Q1, Q2, we did see resume growth. They actually just revised that number from a positive 2.6 to 2.9. So we did have a really good Q3 after a couple bumpy quarters. Now getting a little, well, still good. CPI, this is inflation. Have both the headline and the core, which excludes food and energy prices, graphed out here. You see these are still well elevated, but they're starting to come down very slowly. The Fed is going to continue to increase rates, and we do see these tailing off in the future. So good and bad news here. It's still really high, but it does seem like the corner is turning on inflation. Where we've really seen the inflation and the associated high rates from the Fed impact the economy the most is the housing sector, and the mortgage payments are just really growing with these high interest rates. You have the average mortgage payment increasing $750 for new mortgages, and about 20 million households have been priced out of buying a new home by these higher rates. So that's the main place we're seeing this being a drag in this high inflation environment, and just kind of dampening sentiment in general. Consumer confidence is dropping. Been a bit better the last month or two, but in general, we're entering an environment of fairly low consumer confidence. And these things combined is why we do see at Oxford Economics, that's our parent company that crunches the big economic numbers. We do see a recession coming in 2023. Should say, we'll look at a second. It's a pretty mild recession, but we do see it coming, and this is starting to be the widespread held belief in the economics community that we probably are going to see a recession, but it's not going to be that bad of one. We're talking about unemployment rate bouncing maybe to 4.5%, which is still a really good number overall, but higher than current 3.7%. So, to give an idea of how mild that is, we've kind of mapped our forecast against all these previous post-war recessions, and you see it's outside of 2001, one of the mildest on record. You see that huge dip in 08 and obviously COVID in 2020. So what typically happens to tourism in a recession? So again, here's a look at what happens to hotel demand during recession. We've separated this out by classes of hotels, from the cheaper hotels on the left, the more expensive hotels on the right. Interestingly, the most hurt are the lower scale and the upper scale. Lower scale hurt a bit because recessions generally hit the poorer households harder than middle class and upper class households. So you see a dip there. And then on the luxury side, business travel takes a big knock during recessions too. So that drags down demand there. And overall, we see that demand for hotels generally falls about 4 times higher than the decline in GDP. So, we said earlier, we saw a 1% decline in GDP for 2023. So, in general, we don't believe it this time around, but in general, that imply about a 4% decrease in hotel demand. However, this relationship is very loose. So you see a few recent recessions. You see that 1991 recession, that 4-to-1 ratio held right on. The hotel demand, dark blue, was about 4 times the loss in GDP. So a very clear 4-to-1 relationship there. 2001, really odd. Even though we had a tiny growth in GDP for the year, we had a big decline in hotel demand. That was September 11th. So you understand the impact on the travel industry was felt harder there. Similarly, with the big 08-09 recession, we didn't see that 4-to-1 impact, closer to a 2-to-1, 4% decline in GDP, 9% decline in hotel demand. So this 4-to-1 relationship is a general correlation, but in individual recessions, it can be all over the map, and we don't see that happening this year or next year. How does this usually play out? Again, we have the decline in GDP in the gray versus ADR and occupancy. Again, a variation, but in both 01 and 09, we saw pretty even drops in ADR and occupancy. So that's possible to expect both of those indicators to be impacted similarly next year. And here's why we have hope for the hotel sector in this difficult macroeconomic environment. First of all, we've seen no signs of weakness in travel demand so far. So you see here we're looking at hotel demand over time, and things just look better and better. We have dips, but overall we have, for the first time in September of 22, outpaced 2019 in terms of monthly hotel demand. So as a nation, I know you guys are well ahead of the nation, but as a nation, we're finally back in terms of hotel demand. And you see these generally upward sloping curve through the past year. ADR is recovering even faster than demand. Part of this spurred by inflation, but in general, you see those ADR rates, really rising over the course of the year, and 17% right now. Here's the recovery in ADR compared to prior recessions, and again, you just see that quick spike back up. Excuse me, compared to the 01 and the 08 recessions, where ADR took a long time to recover. Again, part of this spurred by inflation, but another chunk of it is just the recovery's been a lot faster this time around than previously. We've seen similar things. I know you guys have a big short-term rental market, but short-term rentals are doing really well too. So we see that continuing. Just moving on, continuing on the travel industry, air passenger recovery, still not quite back to pre-COVID levels, but doing really well, continuing to grow throughout the year. Again, in the face of reduced consumer sentiment, consumer confidence, high inflation, all the travel sector indicators are doing really well. And households are generally pretty strong as well. Their balance sheets remain strong. We have pretty high net worths, again, even in the face of the inflation and some more difficult quarters recently. Household net worth is still well above the pre-COVID number. We do see inflation slowing. Excuse me. Again, we think that corner is finally starting to turn on inflation, and we'll see lower numbers going forward. A lot of that spurred by the Fed raising rates and reducing demand. Excuse me. Um, Finally, we think there continues to be pent up demand for travel that the people just haven't taken vacations, and they are putting a high priority on. Consumer spending in general tends to be strong, and this is what's really boosting um, the GDP numbers currently. Is consumer spending is strong. Services are a bit slower recovering from the COVID low, but their numbers are still strong year over year. Uh, any sorts of surveys still seem to think things are going really well and people want to travel. You see um, kind of the low COVID numbers that's on the left. That's way back in 2021, and as we move forward, we see that 90% of people are still planning to travel, which is the highest it's ever been post COVID. Um, Different organization, same type of survey. How excited are people to travel? Again, we're seeing indications that people are very excited to take a vacation next year. So overall, in the face of this difficult economic environment, people want to travel, and we expect they will travel. Um, Finally, the weakest segment of travel, the group and business segment that have really struggled while the leisure market has taken off recently. We think group and business travel is going to continue to gain steam and grow even in the face of a potential recession. So here's a look at total group demand. See, lagging behind other travel segments, but making up a lot of room over the past year and a half or so, and we still think that'll go higher. Excuse me, guys. uh, Group bookings again are just a hair off 2019 levels, and we see good results there. Corporate earnings, which are a big strong driver of business travel, are really high. And business travel expectations are actually increasing. So the dark blue number, the Q3 numbers, the gray number, the Q2 numbers, we see expected trips from in the corporate business sector increasing for all these types, or except internal meetings, all these types of travel. So the big difference in confidence and customer stakeholder meetings. So we are going to have more business travel next year. Overall, a quick summary. Again, we do think a mild recession is likely in 2023. Again, mild being about 1% of GDP. Unemployment may be bumping up to the mid 4% range, so very mild compared to the last few recessions, but we do see it happening. And that is increasingly becoming the widespread view in the economist sphere. Normally, this would indicate a substantial drop in travel. We have this 1% GDP to 4% hotel room demand is normal, but we expect that not to be the case in this downturn. Why? We got that momentum that we still see strong. The households, businesses are still doing decently well financially. There's pent up demand, and we still see the surveys indicate that people really want to travel. And business, which has been kind of the albatross on the travel sector's neck, is really going to continue to make up ground and grow in 2023. So overall, we still think we see good things for the travel sector across the nation, and we have no reason to expect different in Myrtle Beach. We think you guys are going to have a really good year next year as well. And with that, I'll be happy to take any questions you have. I'll also be happy not to take any questions. Oh wait, there might be a question. Yeah. So up front, we were looking. This is the question: is how much of this was Grand Strand versus the national? So the first section we were looking at Myrtle Beach numbers. After that, we were looking at national numbers, how we think things are going to do nationally. And we don't have a breakout of different traveler sectors for Myrtle Beach at present. I love questions. Happy to take more. Look at group travel. When you look at group travel, you see differences in markets. Not particularly. I don't see um, some things like some youth sports has recovered last year a bit faster than corporate travel. That's doing a bit better. So their growth going forward won't be as high. Um, but no, we don't see any kind of major divergence in different travel sector or business group travel segments in the future. Advice for rate managers. So we do see ADR remaining strong next year again with that with maybe not quite keeping up with inflation, but we had these really strong numbers last year. I'm trying to think of this Myrtle Beach in particular because you guys have been doing so well. Um, I I would say there's definitely the possibility for some downside if the recession does hit harder. Myrtle Beach ways if people have kind of last year or the last 2 years, they've kind of done their rural beachy type vacations. Maybe next year they want to go to New York City or something a little different. There's the possibility for even some declines in ADR. I think in a place like Myrtle Beach that's done so well recently, but nationally we see them just slightly ticking up from where they were in 2022. What do you see the price of pump gas prices? Boy, that's a big old question. I'd be making a lot more money if I could forecast gas price well. They have gone down the last few months. I don't know how often you guys are filling your tanks. They are at about the pre-Russian invasion of Ukraine level, so they're back to kind of where they were in January of 2022. Uh, we see that staying, or I think I'm trying to remember. I haven't seen our forecast there. I do think we have it decreasing, which is pretty common for a recession. As global demand for gasoline tends to go down during recession. So I imagine our forecast is going to have them tailing off a bit, but uh, that's a tough one to forecast. Obviously, it can go so many different ways for um, reasons that go well beyond economic. Okay, Caroline, do we want to call that a wrap?
Yep, if no one else has any other questions, I think so.
All right. Well, again, thank you all for having me. I hope to have the opportunity to be back here again. It's a pleasure working with the Myrtle Beach DMO, and you guys have a great rest of your day.